Good news and bad news. The good news, the market just cleans itself. The bad news, it did so in the most brutal way possible. What we witnessed on Friday, October 10th, was not just a dip. It was the biggest liquidation event in crypto history. Billions gone in hours. Blue chip coins got obliterated while many meme coins held better than so-called serious projects. This was not a normal move, it was a once-in-a-cycle purge, a full reset of over-leveraged greed. And it might have set the stage for what comes next. Quick note before we go deeper, this was not an Athena's stablecoin USDE failure, like Luna's debacle. The core issue started on Binance, where wrapped assets and USDE were priced off Binance's own spot book instead of external oracles. That design choice opened the door to a targeted attack during macro stress. Here's the strange part. Meme coins survived better than blue chips. While Bitcoin, ETH and Sol were getting nuked, meme coins held or even bounced. How is that possible? It comes down to where the leverage was. Blue chips live on major exchanges. That is where billions in open interest stack up. When the cascade starts, the largest pools move first and fastest. Meme coins live in a low-leverage, fragmented liquidity trenches. They are chaotic, but they are also insulated. When the nukes go off in the main battlefield, the meme trenches sometimes stay oddly calm. Let's start with numbers. Over $19 billion in liquidations in under 24 hours across Bitcoin, Ethereum, and majors. Longs were wiped as prices reached liquidation levels. Open interest evaporated. This was bigger than FTX collapse in terms of forced liquidations in a single day. Bigger than 2020 COVID crash on a liquidation basis. And for context, earlier this year we also saw a massive liquidation day, about $2.3 billion, right after signed an executive order imposing new tariffs, 25% on imports from Mexico and Canada, and an additional 10% on China. That headline sparked broad inflation fears and the risk of sell-offs across markets. We made a detailed video breaking down that move. You can compare the two events to see what's similar and what's different. It was a coordinated flush across venues and products, from perps to margin to cross hedges. By the end of the day, the market structure had been stripped clean. Open interest collapsed, funding flipped negative, and the leverage stack got reset. This was not just a price crash, it was a structural liquidation event. Now let's walk the actual sequence, because this is the heart of the story. 1. Binance's unified account let traders use assets like USDE, WB ETH, and BN Sol as collateral. The key design choice, Binance valued these assets using its own spot market and internal index formulas, not external oracles or redemption prices. On October 6, Binance announced a change to move these wrapped assets toward oracle-based and redemption-aware inputs. The rollout was not immediate. It landed October 11 to October 14. That left an 8-day window. 2. During that window, sophisticated actors dumped roughly $60 to $90 million of USDE on Binance, plus wrapped BETH and BN Sol, exploiting the internal pricing. Only on Binance, Athena's USDE, a supposed stablecoin pegged to $1, traded down to about 65 cents. Because the unified accounts marked collateral to Binance's own books, margin value for those positions evaporated on platform. That instantly triggered $500 million to $1 billion in forced liquidations that then began to cascade outward. 3. Minutes later, the 100% China tariff headline hit the tape. Macro fear spiked. Friday liquidity was thin. The internal pricing shock now had a perfect smokescreen. Panic widened spreads and dragged cross-venue hedges into the mess. 4. Hours before the tariff headline, fresh wallets on Hyperliquid opened about $1.1 billion in Bitcoin and Ethereum shorts. Funding came from roughly 110 million USDC. As the Binance cascade unfolded and Bitcoin and ETH cratered, those shorts netted about $192 million in profit, before closing into the bottom. The timing and the funding paths look coordinated. Bottom line is, it was not USDE protocol failure. It was a targeted exploitation of Binance's internal collateral valuation system. A local depeg on one venue nuked margin, which triggered forced selling, which spread to the rest of the market, right as the macro shock arrived. A small shove, less than $100 million in pressure, toppled a bridge that was holding up $19 billion in global leverage. Let's be precise. Binance is the root cause. The pricing design plus the delayed rollout of oracles and redemption-based inputs created the whole. After the event, Binance acknowledged platform-related issues, announced compensations for affected margin, futures and loan users, added minimum price floors for USDE, and integrated safer index logic. Exploiters pushed USDE, WBETH, and BNSOL on Binance, where internal books would mark down collateral. They profited by shorting Bitcoin and ETH elsewhere, mainly on Hyperliquid, set up hours earlier, closed near the bottom. Ethereum's USDE not at fault at the protocol layer. Mint and redeem remained live, the system stayed fully collateralized, and the peg held everywhere else. The aberration was local to Binance pricing. Before the crash, the biggest volumes were still on centralized exchanges like Binance and BitGet. They're fast and deep, and they also have rules. Centralized exchanges act like referees. They can monitor market makers, freeze rogue accounts, and detect spoofing or manipulation in real time. Decentralized perp venues have exploded in the last year. On-chain perps are transparent and permissionless, which is great for access, but there is no human referee and no single throttle on behavior. When on-chain order flow is highly transparent, every liquidation level and stop cluster can be mapped. In normal times, this is just information. In stressed times, it becomes a target map. Now at the calendar. It was Friday. Traditional markets were closed or winding down. That means thinner liquidity and fewer hedging flows, and less cross-asset support. If you want maximum impact from a localized shock, you choose a thin window. The attackers did that. You could see the exchanges effect in real time. Some altcoins printed extreme weeks on Binance and on perp DEXs. There were prints that took coins down 60 to 80% in minutes. And on certain pairs, the absolute bottom tick flashed near zero. For example, Atom flashed from around $4 to near 1/1000th of a dollar before snapping back. These were exchanges-specific, thin liquidity weeks, not broad spot market consensus. I was watching Eigen during the cascade. On Hyperliquid, it traded around 80 cents at the lows, while on Coinbase, it held near $1.4 at the same moment. That spread shows how the global liquidation chain hit the most levered exchanges first. The casinos bled. More conservative centralized exchanges like Coinbase acted as a relatively calm harbor, where pricing stayed closer to fair value. So the crash was not just macro, it was exchange design, on-chain transparency, thin Friday liquidity, and reflexive leverage all colliding at once. Some veterans flagged the setup days ahead. Too much leverage, too many late longs, funding reach across majors. When the break came, experienced traders shorted the first leg and flipped long into the rebound. This is not luck, that is discipline and position sizing under stress. This felt like 2021 liquidation cascades, but faster and more feasible. Forced sellers dominated, so prices detached from fundamentals. That is why stronger projects dumped more than their intrinsic value. It was a flash crash, not a secular top. Volatility turned into a transfer from overexposed traders to patient ones. At this scale, it looked like chaos. It was not random. It was a targeted exploitation of how one venue priced collateral hidden inside a macro panic. Weeks were most volatile where inputs were weakest and far more muted elsewhere. There is a deeper habit here. Perps are crypto's main stage now. Every exchange caters to the dopamine loop 5 times, 10 times, 25 times. The slider becomes identity. If everyone is leveraged, one shock becomes a chain reaction. Tariff news did not destroy the market. Leverage did. A spark set off a powder keg built by speculators. Automated liquidation systems do not blink. The cascade does not care about your conviction. This is why margin discipline beats narrative conviction. You can be right on the story and still lose everything if you size wrong. Nowhere did the wicks look nastier than on decentralized perps like Hyperliquid. Even 1.2 times leverage was not safe on some pairs. Cross-margin accounts got sliced because the internal nukes on Binance spilled liquidity stress across venues and market makers hedged in a hurry. Here's the survival rule that never changes. Keep most of your balance in cash. Deploy the minority and prefer isolated margin over cross for volatile assets. Survivability matters more than conviction. You cannot win if you get liquidated. So where do we go from here? This was the reset. Every bull cycle has a cleansing moment that wipes out excessive leverage and resets the field. The FTX collapse was the bear market flush. This event was the bull market reset. Here's the hard truth no one likes to say out loud. Most of the bulls holding margin into this move got wiped. Ironically, those were the same over-levered buyers who could have pushed us toward $180,000 Bitcoin and $8,000 ETH. That fuel is gone for now, and will take months for them to lick their wounds, rebuild trusts, refill accounts, and step back into the risk. Until then, spot flows and disciplined sizing will drive the tape more than euphoric leverage. There is a common pattern in trading that wicks tend to get filled. Will it happen this time? Maybe, but not on schedule. Wick fills are path dependent. If liquidity rebuilds and funding normalizes, prices can revisit those zones. If new catalysts emerge and spot demand leads, the market can base higher and leave parts of the wick behind for a long time. Treat the wick as a reference, not a promise. Big money took profits, retail panic sold, the greed premium died. What remains is a leaner and cleaner market. Here's the real lesson. A $90 million shove on one exchange plus a $1.1 billion short elsewhere detonated $19 billion in global liquidations because one pricing input was wrong. Fix the inputs and the whole system gets stronger. Crypto doesn't end with liquidation, it evolves after one. Volatility is the price of progress. The market cleans itself to prepare for the next move. Stay sharp, use isolated margin, size like a professional. Do not bet against a system that just survived its biggest flush in history. So if you liked this video and you would want to see more investigations like this, like and subscribe. And keep an eye on our next video that we are preparing. Volatility doesn't end the cycle, it restarts it.